Canadian inflation cooled in July, but is that opening the door for a potential rate cut by the Bank of Canada in September? Joining us now to discuss is Robert Bowes, Senior Macro Strategist with TD Securities. It's been a couple months now, I think 4 by my count, of headline inflation below the Bank of Canada's target. What were the details? What was behind this 1.7?
So, at surface level, there weren't too many massive surprises. The market was looking for headline inflation to come in around 1.8%. We came in at 1.7. Core inflation measures were expected to come in at 3.1%. The two that the bank puts the most weight on came in at 3 and 3.1. So overall, just a little bit softer than expected. But the details of that report were quite a bit more dovish and are likely to give the Bank of Canada a little more confidence that inflation pressures have been contained. Within those core inflation measures, you are seeing some stabilization in core goods prices. So with all the uncertainty about how counter tariffs are going to feed through into consumer prices, we are not seeing much evidence of broad tariff impacts in the data so far. And while those core inflation rates that the bank puts the most weight on are still running around 3% year over year, if you look at just the last 3 months by themselves, those 3-month annualized rates of core inflation are sitting below 2.5%. So whether that is for those two CPI trim and CPI median, or looking at other measures of core inflation, because the Bank of Canada, they love to look at a range of different individual measures. Those are sitting closer to 2%. So as that downward pressure starts to emerge, that should give the bank a little more confidence to look through those higher year-over-year rates. And while it is still far too soon to say mission accomplished on keeping inflation near target, you do still have carbon taxes coming off, and that's putting a lot of downward pressure on headline. It does seem that we are seeing some of that persistence in underlying inflation start to fade.
There's some reason here for the Bank of Canada, the inflation numbers, you said, to start feeling a little more confident about the path that we could be on. The jobs market, too. If you start putting the different parts of the Canadian economy together, what kind of picture is it painting for the economy, and what does the Bank of Canada do with that?
So over June and July, the bank, had this discussion where, they were deciding between, cutting rates or keeping them on hold. And in both of those meetings, they kind of characterized the economy as, softer but not sharply weaker. The two factors holding back individual members of governing council are, one, that inflation pressures have been more persistent than initially thought. So they want to see more evidence that those inflation pressures have been contained. We are getting more of that with today's report. We will still get one more CPI report for August before the next decision, but
I think it's the day before the next decision. Talk about
the day before, hour. Just a little last-minute wild card. So while we think if the inflation backdrop remains similar, that likely ticks the box of seeing inflation pressures contained. We just need to sustain the progress that we've seen in July. The outlook for rate cuts is also, conditional on a weaker economy, but, we are still seeing more evidence of softer growth come through the real side of the economy. You mentioned the labor market. Even if we sort of look through some of the larger one-time moves in recent months, that 6-month hiring trend is still sitting in very subdued territory, just about 4,000 to 5,000 jobs per month. So we have seen more slack enter the labor market. That is helping put more downward pressure on inflation. And together, those two factors do leave an open pathway to a September rate cut. Now, like I said, we do need to see confirmation of softer growth in Q2. We do need to see that inflation progress sustained. But we think, after today's report, the September rate cut is looking, more likely than it did before this morning's data.
Right now, the Bank of Canada's policy interest rate is 2.75%. Do we consider that neutral? Is that restrictive? If they actually do start cutting in September, should we expect more cuts? They have room here?
It's in what we'd call the neutral range. The Bank of Canada, doesn't like to pin itself to any specific number, whether that is, a measure of core inflation or the level of the neutral rate. They believe the neutral rate is somewhere between 2.25 to 3.25%. Take the midpoint of that range, we are right on their estimate of neutral. Traditionally, the Bank of Canada would not, if they believe they were sitting at neutral, they wouldn't resume or restart the easing cycle just to go 25 basis points below that midpoint. So from here on out, we think that if they do start easing again, 2 cuts are more likely than 1. We have rate cuts in our forecast in both September and October. And that 50 basis points of easing would bring rates to the bottom half of that neutral range. It would provide a little bit more stimulus going forward. To do just 1 cut probably means that they were either looking to do more and then the circumstances changed on them, or perhaps the need for policy might not have been need for further stimulus may not have been as great as they initially thought. So there is a higher bar for just doing 1 move after neutral. If you're at neutral and you want to bring rates into stimulative territory, it generally takes more than 25 basis points.
Since we haven't had an announcement, at least I didn't hear one while I was away for a couple of weeks, of a budget in the fall, I'm assuming we're going to get one at some point after September. Could that be one of the wild cards to see what the federal government has plans, including anything that could be stimulative for the economy?
That is certainly, one of the factors that the Bank of Canada is going to be incorporating in those meetings over Q4. Now, our view is that a budget is, likely to arrive sometime around the, second half of October, first half of November. That generally tends to line up with the timing of those fall economic statements. And that does introduce a potential wildcard for that October BOC decision. The bank generally does not include fiscal measures until they are officially tabled in a budget or a fiscal statement. So if you do get that budget, sometime around the first half or middle of October, that does give them a little more time to incorporate that into their next policy decision, into those economic forecasts in the October MPR. If the next budget does not arrive till November or onwards, well, then the October MPR is just going to be lacking those fiscal stimulus measures. So the Bank of Canada, does not incorporate those until they're officially tabled. So the question of just how much stimulus they do incorporate in their next forecast update is going to depend on just how quickly the government can turn around that budget once Parliament returns in the fall.